Market mapping is a technology that I've developed that gives you an idea of what the market would normally do. You evaluate whether or not it's fulfilling that, because when it fulfills its map, it more often than not will indeed fulfill it.
We are back. Today we have a very special guest, Rob Mitchell. Rob, thanks for being with us.
Hey, thanks, Mike. Thanks for having me on. I started my first trading in like 1979. When I was in university still, I started developing automated trading systems. That was back before there was any software for doing anything like that. That summer, my wife had an internship in Houston. I spent the whole summer coding up systems and started actually trading at that time. A firm in New York figured out what I was doing. Somehow I came up on their radar, and one day I got a call from the CEO, and he goes, "Do you know who I am?" And I'm like, "No, I don't know who you are." And he goes, "We've got over 600 brokerage firms under us. We want to raise some money for you." And I was like, "Oh, whoa." I exploded into a career as a commodity trading advisor because at that time, we were kind of at the forefront of automated trading before anybody was really doing it. And we were just killing it. And then later on, as you had just mentioned, we were doing different kinds of services. We had a service called E-mini Forecaster, which was actually projecting the entire week a day in advance, which is actually a form of market mapping. I entered the Robins World Cup Trading Championship and won that in the E-mini using market mapping technologies with a website that we had called E-mini Forecaster. And in the beginning, we would print out 4-minute charts and we would hold them up on the screen and see if we could get a match. That was how the first market mapping began. Like you had mentioned, I won the Robins World Cup, and I've worked with Joel Robbins for many, many years, going way, way, way back. And it's been an interesting ride.
That is an interesting ride, an interesting journey. So let's talk a little bit about this market mapping. I told you earlier I was watching a couple of videos of very interesting technology.
Like I said, in the beginning, we were doing transparencies, holding them up on the screen, but I found that that doesn't give the market enough freedom. It's like kind of like raising a kid. You know, when you let go of the seat on the bicycle, that they're probably going to crash. Well, you do the same thing with a market. You give it room to breathe and try to not force it to be a certain thing. It's kind of like a thumbprint. And so market mapping is a technology that I've developed that gives you an idea of what the market would normally do. It's really all about normal. And then you evaluate whether or not it's fulfilling that, because when it fulfills its map, it more often than not will indeed fulfill it.
So we're talking primarily price ranges here.
Yeah, so there are actually 4 different categories of market mapping. One is the ranges itself. The next one is the edges. Markets like to trade for their 30-minute edges, for example, or other edges. You can look at the VWAP as edges or the overnight high, overnight low as edges. And another is something that we call walks, where the market tends to make consecutive highs or lows during a certain interval of time during the day historically. And if a market is fulfilling that, it will tend to fulfill it as well. And then, of course, you can put all those together into the same kinds of things. There's other kinds of maps. I could show you a map if you want to. For the NASDAQ, for example, let me pull over a super map for that. There's a lot of information here, but I would urge the viewer just to look at the one thing that I'm going to show so that we don't get out of control. But like in the NASDAQ, I've got a chart back here behind this for the NASDAQ that's playing right now. But for the first 30-minute period of the day, 9 a.m. Chicago time, the range that I expect for that A period is actually 100 handles in the NASDAQ. So in the period before that, I only get like 36. But this particular map shows me what I would expect going back in time over those periods. But the simplest one is just this range 1 cell right here. I glance at that before that commences, and as long as I've made that 36 right there in the prior period, I'm expecting that 108. Then you have to take it to the next question, and the next question, of course, is what can I do with that information? If you don't take it to that, it's just a number, you know. So today, I expected 102, as long as I had that 42 right there.
If you don't get the 42, then the column A is a little less, and if you get more than 42, does that number go up a little bit?
I won't let it go up. It's all about minimums.
Makes sense.
So what I want to do is, from a trading perspective, as long as I got that 42, I'm going to be looking for the 102. As I'm moving towards the 102, I want to make sure if I'm exceeding that, that I'm in a status of a runner. I don't want to be initiating new positions after I've gone, 102.
So let me kind of just see if I get this. So what you're saying is that in that time period, that A time period, there's 102 potential handles there. It could be up or it could be down. That's going to be determined by some other tool. But this gives me an idea of where the market could go.
It's telling me what's normal. Now, if I'd gone 102 and -1, I might be a little suspicious about whether or not I could do it because this is telling
I
me that
see.
the two periods ending A or -1 and A together, I should only have 120. So if I've exceeded 120, because that's what's normal, I have to consider if I got 120 in -1 that I may have arrived early. And I like to convert these things into people. So if you're with mom and dad in the car or whatever when you were a kid, whatever metaphor you want to use, if you arrived early, it's not polite to go bang on the door early, so maybe you go do something or you wait out in front of their house or whatever before you show up. So there's several considerations there. If I arrive early, I want to be careful. If I come in right at 42, that's like screaming normal, and I'm really looking for that 102. And so this is just the most simplistic example. Another one that I really like to do on the Globex, I'll look at the Globex range overnight, and then what that number right there down below tells me is that I expect that that is 46% of the Globex range. And so I can take whatever number I actually have for the Globex at that period before the open, and I can project that that's going to be, roughly around 300. And so I expect that it may try to do that.
That's interesting. Can you maybe walk through a simple scenario where you're getting ready to make a trade and you use this as a piece of that?
Yeah, so this morning we could maybe try to do an example here. It looks like -1 period came in a little light. That came in at 35, and our number that we were looking for there was 42. So what I might do is just using this, I have a table that helps me to just glance at those and tell me what it is. But if I only made 35 out of 42, and I do the math for that on the calculator, I made about 83%. And so I'll take my 102 times the 83%. And so I'm looking for roughly 84. Instead of the 102. So that's the way I would do that. If it were the open here, I would be saying to myself, I'm looking for 84. And then we could see what we actually got. And we got 92. So when this guy came down like this and rolled over like this, I'm saying to myself, I'm looking for 92. Now, here's the interesting thing, Mike, that's just absolutely mind-boggling that we discovered in this process. Normally, you would think that that's a average or a median value, right? It's a normal value. Well, what we found is that the probability of this hitting that average value, if you will, is not average. The probability that it actually hits that becomes way higher as long as I'm making that 42 in the period before. Does that make sense?
Yeah, you have another spreadsheet that shows that probability, right?
I do, and that makes it because I don't want to be doing math while I'm trading. That's the last thing in the world I want to be doing. That's like texting and driving, which actually brings up another point. So am I like sitting here looking at this thing the whole time I'm trading? No, I glance at this just before the end of the period. I kind of have an internal clock. And about 5 minutes before the end of the 30-minute period, because these are 30-minute periods throughout the day, I just glance at it. And I'm like, okay, I'm looking for 84 in this next period. Oh, I only made 84 in this one. These two numbers are similar. I'm probably looking for roughly the same for B period, etc. And I don't try to over literalize it or anything like that. And this is just market mapping 101. And as long as I'm following that, it will tend to continue following it at a probability way higher than average. And so that's the trick, is we've found where average is no longer average. Is really what we've done with that.
Can you share the amount of history that's used to build this?
This particular table is only using 10 data points. I can do them larger, but what we found is that as I use this on an ongoing basis, the more recent data is more valuable than the further back data.
I completely agree with that. The market's always changing, and you want to look at the most recent data. I totally agree with that. I've always kind of used that in my back testing as well.
I don't actually do back testing. What we do is we look at the market and we identify the patterns within it, and then we confirm what we're observing, which is how you're supposed to do science. You observe, you don't sift through a bunch of data, because where you're doing that, you can run into the situation where random is random. And I don't want to trade random. I want to trade non-random. And that goes back to that earlier example. If I made my 120 before I got to A, then I know I'm definitely not random anymore. Actually, we could do it with this one as well, because we talked about what are the different things that we can do with market mapping. Well, one is the ranges. The next one is that I expect to take out the prior period at 100%. Now, of course, that's not a guarantee. That's what it has done in the past. And I know from using this for long periods of time that that actually goes way back further than that. So A period is here, and I expect A period to take out -1, -2, -3, -4, -5, usually all the way back to -8 or even more for the NASDAQ, I will expect it to take this out. And because those numbers are what they are, I expect it to actually do it in the same direction. Again, this is market mapping 101. So I came in at this number, I interpolated it to 92. I do that just at a glance. I don't get all caught up in the math, and I want to trade this for that end result. And so that's how I would trade it. But at the same time, I'm looking for it to take this -1. So if I can figure out a reasonable trading opportunity up in here, I might trade for that, or etc. So the trading method itself is an entirely different thing. Now, this is where the probability stacking comes in. I'm expecting to take the -1 edge. When I failed to take that -1 edge up in here and started coming this way, I start knowing that it's going to try to do it on the other side. I know that A period is expected to be, what do we have, like at least 3 times what the -1 is. And so as it comes that way, I might be looking for my order flow. As this order flow metric comes out of this yellow box, I call it coming out of the box right there, and the momentum's going with it. You want the momentum going in your direction and everything else. You see if you can find yourself a trading opportunity towards that expected outcome of taking the prior range and of meeting the expected range of, I think we had about 84 or something like that.
Traders don't really think of magnitude like this very often. This is really a unique way of being able to set where you expect the market to go. Everybody sets stop losses, but everyone's always a little bit shaky on how far can this market move. And this is just a really cool way of making those measurements.
Yeah, and the NASDAQ in particular, when we did this a couple of weeks ago, I pulled this up because they were talking about the NASDAQ before I came in, but the magnitudes in this particular market are staggering. But you also have to be careful because this bad boy moves. Real careful. The skill set of trading in this kind of environment, you have to be wise and nimble. And a lot of this whole thing about market mapping, Mike, is really about putting yourself in the future tense so that you can paint a picture in your mind, because it's my personal belief that if you do not have a vision for 2 things, number one, what's the market trying to do, which is what these market mapping things are, efforts towards answering that question. And number 2, what's the most likely direction for range expansion? And from these market mapping methods and the answering of those 2 questions, I paint a vision in my mind as to what it's trying to do. And it's a real game changer to trade that way, because if you have a vision for what it's trying to do and what's the most likely direction for range expansion, and it fills that picture in, then you're engaging in some kind of prognostication, or you become kind of a prophet, if you will, and you work towards having that experience over and over. And with these maps, it's cool because you do that every 30 minutes all day long.
We are out of time, Rob, but you're in the NinjaTrader ecosystem, right? You've got
Yes.
tools in there. How else can people reach you?
Indicatorsmart.com. That's the hub. So,
Well, this has been fun. I really appreciate you being here.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.